Hi, everyone. I'm DJ Shaw with Vetify. I'm joined by Paul Bialke, Head of Fund Sales and Strategy at SS&C Alps Advisors. Paul recently joined the ETF Prime podcast to discuss 2025's biggest trends, specifically the resurgence of thematics and the rise of active management. Today, we're digging deeper into two opportunities highlighted: electrification infrastructure and active fixed income. Paul, thanks for joining us.
Good to see you. Thanks for having me.
You mentioned on ETF Prime that the return of thematics was a major surprise in 2025. Beyond just improved market sentiment, what specifically is bringing advisors back to these strategies right now?
Well, I think it's a reevaluation at year end and into the later stages of what has been a really strong equity market cycle around where your portfolios are most concentrated, how those portfolios reflect some of the most important themes in the market, and if the conclusion is that you're not getting representation of the companies that are at the forefront of some of the most important themes in the market, whether it be electrification, whether it be energy transition, whether it be innovation in the medical space, that you're trying now to figure out ways to offset or complement your core equity exposures with portfolios and strategies that affect those types of portfolios. And in many ways, electrification is a great example of that because we read so much and see so many headlines about increasing demand for electricity coming from AI, which of course the electrification theme extends beyond simply AI data centers, but they're trying to think about what are bottlenecks to our implementation, our ability to implement AI. And a lot of what advisors and investors are coming to realize is that a lot of the categories that stand to benefit from rising electricity demand, utilities, materials companies, industrials companies, aren't typically well represented in an equity allocation because those aren't the sectors that dominate the market cap weighted view of the market as expressed by the S&P 500.
Regarding the Alps Electrification Infrastructure ETF, ELFY, you noted the real opportunity might be in boring sectors like utilities rather than AI tech giants. Why do you believe those downstream infrastructure plays offer better upside?
Well, in some ways, it's kind of the picks and shovels approach that we read so much about in our history classes around the gold rush, where the people who actually got money weren't the people who went out to California or went west in search of gold. It was the people who provided them with the equipment to go out and search for gold, in many cases to no end. And in many ways, the electrification theme and ELFI as a representation of that is designed to be just that. It owns the pipelines that ensure the natural gas gets from where it's produced to where it's consumed, which might be at a utility, might be at a data center, which is equipped with multiple gas turbines provided by, say, a GE Vernova or Mitsubishi, names that are in the portfolio. And then, of course, the utilities, a traditionally defensive segment of the market, are companies that provide electricity to consumers and to enterprises. So in many ways, ELFI takes a downstream view of the electrification theme, and in some ways, a downstream view of the AI theme, because we see these headlines around these massive CapEx budgets, these massive commitments by these large hyperscalers. And what you don't necessarily see is just how much infrastructure is going to be needed to be invested in to support that. We hear about the chip demand from key companies like NVIDIA. We hear about software demand and the opportunity set around AI. But what gets lost in that is the massive amount of electricity demand that comes from AI data centers. And then you layer onto that things like reshoring, EV adoption, heat pumps, as well as induction stoves. And the chart of electricity demand growth expectations, depending on the forecast you read, are significant. And the companies that are providing electricity, that are mining for the metals that are necessary to support grid infrastructure development, as well as the companies who own the assets that ensure that energy gets to where it's increasingly consumed, are the heart and soul of ELFI.
I want to switch gears and talk about active management. We've seen massive inflows into active ETFs this year, particularly in fixed income. Why do you think investors are increasingly choosing active managers for their bond portfolios while sticking with passive for equities?
So I think in some ways, the gospel for ETF investors for a long time has been SPIVA, the report on active versus passive performance. And year after year, that report comes out and it shows that it's very difficult for an active large cap manager to outperform the S&P 500. And that's being reinforced by decades of data. And yet in fixed income, a large percentage of active fixed income managers are able to generate outperformance above and beyond what is the typical benchmark, which is the AG. And so I think investors in ETFs as a wrapper have come to the realization that there are categories where active management can and does generate meaningful risk-adjusted and absolute outperformance, given that you hire the right manager, they have the right process, and they have the right repeatable approach to portfolio management. And if there is the opportunity to improve upon a benchmark, which in the case of the AG is inherently flawed, just given that it wasn't designed to be investable, but rather a measurement tool. Investors have come to realize that not only is there opportunity there, but the asset managers of the world who have star fixed income managers are also coming to the table with ETF offerings that allow them to have the choice of their favorite manager that might have once upon a time only been available in the mutual fund wrapper. So in many ways, it's a convergence of massive trends that we've all been living as ETF assets continue to grow and as ETFs continue to set a record.
And your actively managed Alps Smith Core Plus Bond ETF, SMTH, has seen a lot of growth recently. With rate cuts likely on the horizon, why is a Core Plus strategy the right tool now compared to just holding cash or passive aggregate bonds?
Well, first and foremost, the success of SMTH is pretty remarkable. If you look at the AUM north of $2 billion, less than 2 years since launch, it's a testament to the team and the story and the process. But it's also an indication that in this moment, we're at the very least expected to get a couple more rate cuts from the Federal Reserve, whether it's this month or whether it's in early 2026. And anytime that happens, that means that the yields on offer in cash equivalents or shorter duration fixed income naturally go down because that's the lever that they pull. They can manage QT or QE, but in terms of interest rate policy, it really only affects directly the short end of the yield curve. And so investors who have been comfortable sitting in cash or sitting in CDs or sitting in cash equivalents, money market funds, or otherwise have been rewarded with pretty attractive yields as the Fed embarked on a pretty aggressive rate hiking cycle. Now that we're expected to get more rate cuts and the yields on offer in cash equivalents, money market funds, and shorter duration fixed income are expected to go down, investors, especially older investors, are looking for ways to improve the yield. And in fixed income markets, that typically means taking on more duration, which means moving from, say, a short duration or ultra short duration strategy to something more akin to core and core plus. And the benefit of being in SMTH is you get access to a very conservative fixed income management team headed up by Gibson Smith and his lieutenant Eric Burnham, who are always thinking about capital preservation around everything else. And their duration management, their credit exposure, all of it is designed to ensure that the portfolio is doing what fixed income is supposed to do, which is to be a ballast within your asset allocation. And at a moment when many investors are looking to take on more duration risk, it's important to be thoughtful about it and not just to simply go out and take on the highest duration portfolio or take on the most risk, but really to trust someone who has experience managing fixed income strategies in a wide range of environments. Because if the past couple of years have told us anything, we don't really know how the next couple of years are going to unfold in terms of fixed income returns, in terms of equity returns. But having managers who experience the ups and downs of various cycles is paramount.
Looking ahead to 2026, you've questioned whether the market will finally broaden beyond the Mag 7. If that happens, how do strategies like Elphi and Smith help investors diversify away from that concentration risk?
Well, as we talked a little bit about in Elphi, this just is a portfolio that represents a lot of names and a lot of sectors that you don't typically have a lot of exposure to in your S&P 500 oriented equity allocation. Utilities, 2% of the S&P 500. Energy is 3%. Energy infrastructure is a small portion of the S&P 500's energy sector. Industrials, materials, all of which add up to a very small slice of your typical asset allocation within the equity sleeve. And that helps to offset the concentration in theory of the S&P 500, which is north of 30% in technology, north of 50% in the three sectors that have dominated the market's return and hold those Mag 7 companies: communication services, consumer discretionary, and technology. And so in many ways, if the market is to broaden out, having sectors that don't have strong representation and a cap weighted view of the market, if that is your starting framework for allocating equities, can be an offsetting dynamic. I would add international as an example of a diversifier. I would add small and mid caps like in OUSM as potential diversifiers if the market were to broaden out, as well as a value oriented strategy like SDOG, or even a quality oriented strategy as OUSA, which all seek to achieve the same thing, which is to take your beta, which is the S&P 500, at least in terms of a benchmark for your large cap allocation, and which has been so dominant in terms of its attribution in the market's return in this cycle, and provide ways to broaden out the diversification possibilities of your equity allocation, but also importantly, change the factor composition of those equity allocations.
All right. Thank you again, Paul, and thank you all for joining us. If you want to learn more about these strategies, visit the ETF Building Blocks Content Hub on ETF Trends or ETF Database.